Hi, my name is Charlie Sault, and today I'm going to go through my analysis of the 5 firms in the apparel and textile industry and 5 firms in the soft drink industry. I'm starting with the apparel and textile, and the 5 firms I chose are Nike, Under Armour, Quicksilver, Fossil, and Wolverine. Starting with current ratio, we can see here on the graph that all firms are fairly similar in the range from about 2.5 to 3.5. They're all liquid enough to pay their current obligations. There's some volatility in there with them, but in 2013, the most recent year, everyone's in good standing to be able to pay all their bills that they need to. The question is, where are they getting this money from, which we'll explain in further ratios. Are they getting it from leverage? Are they having excess cash flows they can keep back? That's an important question to answer about how the firm is being run. This is showing financial leverage here, which is how much debt the firm is having. So as we can see here, Quicksilver has consistently had the highest amount of debt out of all the firms. Wolverine have seen a sharp increase in the last 3 years. They've gone from 1.45 in 2011, now in 2013, the most recent figure, they're at 3.53. So they've seen a sharp increase in their amount of debt. As I said, Quicksilver has a lot. And then you see here, Nike, Under Armour, and Fossil have very stable, very low levels of debt, which is good. It means they're less risky. That you're not expecting any sudden increases in how much the firm has in leverage. One thing to say is that these firms who have more debt might be doing that because it's cheaper for them to raise capital that way in terms of their WACC. But it's very weird to see such a huge increase in such a short amount of time. So we need more information as to why exactly Wolverine has increased so much. But I personally would prefer to go with the 3 who have less debt, as it's less risky. Going on to asset turnover, this is an important factor to consider because it's showing how well the managers are using their assets that they have at their disposal. Nike, Under Armour, and Quicksilver all have fairly stable, fairly good asset turnovers. You can see Wolverine was with them and then dropped off significantly in 2010. This is a very important factor, I think, because it's a component of ROE. As I said, it truly shows you what you're paying your managers for. You're employing managers to make use of your resources as best they can, and this is a great way to show it. And as you can see, as I said, Nike, Under Armour, and Quicksilver performing well, and it's very stable, and so that's a great thing to look for. On to profit margin. Another component of ROE, which I think is the most important thing when considering what to invest in. And it's essentially saying how much money is the firm making, what margins they're running on. It's generally relative to the industry, so you can't really compare them across industries as well as you can compare them within the industry because different industries see different margins as a norm. Quicksilver is obviously struggling, as we can see here. It's got this kind of upside down U shape. They haven't seen a positive profit margin in the whole period, which is from 2009, and that to me already says that it's not an attractive investment. The firm just isn't making money, and so as far as I'm concerned, it's too risky. It's not somewhere to go. Nike and Under Armour, yet again, stable. Nike's averaging 9.45% and Under Armour 6.45% over the whole period. As you can see, there's not a lot of volatility, very stable. Investors know past performance has been very good, and that gives them good peace of mind. Fossil is actually the best in this category, above all the rest. Yet again, very stable, over 10%. It looks good there, and I would have liked to have included interest burden next. However, there was missing data for some of the firms, and so I decided not to. But yet again, it would have been another component of ROE I could have included that would have been nice to analyze to see how much how well and how easily these firms can pay for their debt. This for me is the biggest indicator I look for when analysing all these firms, their return on equity. Profit margin and total asset turnover are the most important things when you're looking at analysing ROE. This is because this is the one thing that you're paying your managers to do. You're paying them to have good margins, you're paying them to use your assets well. You don't just want ROE to be high based on leverage, because that can hide so many other figures that maybe aren't so good just through leverage. And so what we can see here is Fossil's the best again. It's actually increased its ROE 108% over the period. Nike and Under Armour, same sort of thing, very stable, good numbers. Wolverine's seen a little drop off, but it's not predictive of future. They could quite easily get back up there again, and they're still looking very stable, and they've got good numbers. ROA, another component of ROE, and also by itself I think an important financial indicator to look at. Fossil has the best ROA, which is no surprise why it has the best ROE then. Quicksilver's numbers are starting to look almost unbelievable when you see them in this graph for the last three indicators. The firm is obviously in a lot of trouble in terms of almost everything you could do then, they're just not making money. The management at Nike, Under Armour and Fossil evidently across the board are doing a great job. They're not just making these numbers good by taking on a load of debt and hiding other facts, that they're actually doing their job, good profit margins, good asset turnovers. And this will help them, I believe, in long-term performance in the long run. They're not just going to keep increasing their debt to keep their numbers up, they're getting the right numbers right. And lastly, the price-earnings ratio. This is very good when comparing firms together, because within the industry you can see what investors expect in terms of growth for the firm. However, on its own it's not that much use, so it's not very useful to say, oh well, a firm has this, but when you can compare them you can see how investors are viewing each firm. So Under Armour, as we can see here, is leading by quite a big margin. It was 57.92 in 2013, and they've actually managed to double their PE ratio since 2009, the beginning of the period I studied. What they're saying is that investors are willing to pay more for their earnings for Under Armour. They see that it has a lot of growth opportunities, and that for every dollar they earn, they're willing to pay more and more over the period for that dollar. A good benchmark for the industry, I would say, would be around 20, as we can see here. There's these firms here, right around 20. Seems to be the average sort of period, a good benchmark to compare everything to. No surprise again that Quicksilver struggling, and actually when we get to here in 2012, because they stopped making any money at all, they don't actually have a PE ratio anymore. So out of this industry, the firm I've chosen to invest out of these five would be Nike. It topped everyone in two categories that I analysed. It has good ROA, good ROE, and it's also good in everything across the board. One thing I like about Nike is it's very stable. Its numbers aren't volatile, they're not jumping up and down. If you invest in Nike, you know what to expect. And another thing which is hard to quantify in numbers is Nike has a great CEO in Phil Knight. He's taken the firm from strength to strength over and over again. He's a real leader in terms of the industry, and it's very hard to put that into numbers, but I really feel like that makes a big case in why you would want to invest in them, because with him at the head, the possibilities for Nike are obviously endless, as he's shown time and time again. Under Armour and Fossil performed very well, as they did in everything else. I just think as it was such a tight race, the real tipping point for me was just, I think Nike has great management, and I think that's a great thing looking forward to the future. Now onto the soft drink industry. I did the same ratios comparable, so that when I compare at the end, we've got the same numbers to compare from. So, as we can see here, back to the current ratio, Coke, Dr. Pepper and Reed's, they all have a very similar current ratio. As we can see, they're right around here, this bottom line. The problem I found with them is, it's very low. So they could potentially have trouble paying off their immediate obligations should anything go wrong. If there's any sort of shock to the economy, they could have trouble paying off their immediate obligations. Monster is obviously performing well. They had a huge current ratio back in 2009. It's come down a little, but that's fine. They're still very liquid, and it seems to be back on the up again. To financial leverage again, Coke is bad in this category, which actually surprised me. They started off the period with 13.49, and they've actually managed to drop that now down to 7.73. So they're showing huge improvement, which suggests management has seen that they have too much leverage and is actively doing something, which I like. However, to me, it's just a little risky. That's a lot of debt compared to the industry average. It could explain why its ROE would look good. I mean, they have decreased it 41% over the period, but I still think it's just a little too risky there, so I would stay away from it already. Jones and Monster, they actually, both of them are here, they're almost identical over the period, both at 1.55, very good, very low, not taking on a lot of risk. Reed and Jones, they have the best asset turnover. We can see they've been on a steady rise over the period, not too volatile, just a good growth rate. Dr. Pepper actually has an asset turnover of less than 1. They average 0.65 over the 5-year period. This is essentially saying for every dollar they have in assets, they're only generating 65 cents in sales and revenues, which is something that really needs to be addressed. That's showing poor management from the firm's point of view, and they should really take a look at that and try and improve it. Monster, as is a theme throughout this whole industry, it's on the rise. We can see here it's going up, and it could very well be to the levels of the industry leaders very soon. Monster has the best profit margin over the whole period. It's at 15.07% in 2013, and what's amazing about this is Monster's consistently almost 5% clear of the competition when it comes to profit margin. Something that I like. It shows that they found a niche in the market. They can obviously charge more for it, and people are buying it. Dr. Pepper, solid second. It's at 10.4% for 2013. Still very good, a little bit overshadowed by Under Armour, but very good. And as I said, it's important to remember that these numbers are industry specific. So the profit margin you see in the soft drink industry may differ from the profit margins you'll see in the apparel and textile industry. So it's better to rank them and see where they rank and then compare. Jones is in trouble here. It's actually never had, over the period, it's never had a positive profit margin, and neither has Reed's. But as you can see here from this grey line at the bottom, in 2009, Jones was operating on a profit margin that was negative 40%. To me, this has automatically already put it out the running again. Reed's is still bad. It still hasn't seen a positive profit margin over the period. Not as bad. Both of them really, to me, that's a sign that I don't really want to invest in them. If you haven't made a profit in 5 years, then there's something going wrong. ROE, so Monster is averaging 37.16, which is fine to say, but what amazes me about Monster is that they have low leverage, they have high profit margin, and this explains why their ROE is so good. They're not just making their ROE good by taking on a lot of debt, they're actually creating value, and they've got high profit margin, which is why their return on equity is looking so good. Again, Jones and Reed struggling. Not a surprise given the profit margins on the previous page. Coke and Dr. Pepper, as you'd expect, solid players in the industry, right around average, just a little bit overshadowed by Monster in this case. Onto ROA, well, yet again Monster's leading with a 27.49 average over the period. To put into context how much better that is than the second place, Dr. Pepper is second in 7.28. So it's roughly a 20-point increase for Monster, which is just a huge amount. What's interesting though is Monster's not actually first in total asset turnover, but they are first in ROA. And as we can see from the page 2 slides ago, that is purely due to they have a higher profit margin than anyone else in the industry. Yet again, Coke and Dr. Pepper, very stable, average middle of the road sort of deal. And as you can see, yet again, Jones and Reed's are just in dire straits with the last 3 slides. Everything seems to be in a negative, which obviously is a big turn off in terms of wanting to invest in them. Lastly, price earnings ratio. There's no data for Reed's and Jones because they haven't actually made any money over the period, but seeing as I've already decided I wasn't going to invest in them, I thought I would just put the top 3 firms. So we have Coke, Dr. Pepper, Monster here. Monster's averaging 26.5 over the period, and also on the rise. What this is saying is that it's a new firm and investors really feel like there's a lot of growth opportunities in this firm. They're willing to pay more for each dollar of earnings because they feel like the firm is going to grow and grow. As I said, it is a younger firm than Coke and Dr. Pepper, so it has that advantage going for it. And Coke and Dr. Pepper, very stable. They're not moving around too much because they're a little bit more mature. Out of all these ones, in the soft drink industry, I think it's fairly obvious that Monster is the best one. It has the best ROA and best ROE, which I think are the 2 most important factors. Its profit margin, as I said, is 5% higher consistently than the industry, which is something that really tells me that it's captivated a market in a way that no one else has been able to. It shows me it's managed well. You know, they have their ROE is good from profit margin, asset turnover, not just leverage. They have huge growth potential. It's a young firm in the energy drink market, and that market is starting to explode in a big way, and they've really got an opportunity to make a lot of money here and grow a lot. And as I said, they don't have a lot of leverage, so there's low risk when investing in this. Now, out of the 2 industries, I chose Nike and Monster. So when they go head to head, it's very close. Their current ratio and leverage are almost identical, so there's nowhere to pick there. Monster's asset turnover is 0.29 better, but I don't really think this is significant enough to really say one's better or worse. Yet again, similar. The first indicator that told me Monster is ahead was profit margin. Nike's profit margin as a percentage is lower, but we saw that across the industry that apparel and textile work on smaller margins than the soft drink industry. But what impressed me was, as I said, that 5% differential between second place Dr. Pepper and first place Monster. That really stood out to me as a great indicator of how well that firm is performing. As I said, the ROA and ROE were better. Those were the 2 I really looked at, and how they were composed, how they got their good ROA, how they got a good ROE. And Monster was ticking all the right boxes in terms of having good management in place, using their assets well, generating good profits. And Monster also saw a higher PE ratio, which is no surprise because Nike's been around a while now. Obviously a very well established firm, and it will always be a huge player in the apparel and textile industry. Monster, a newer firm with a lot more growth opportunities, so I didn't really take PE into account too much on this one, but yet again Monster won. And so when analyzing Monster and Nike together, Monster's too good to turn down. All its numbers just show so much potential for growth. It's being managed well, run well, and it's making a lot of money. So if I had to invest in one stock out of all of these, it would be Monster. Thank you.